This graph has predicted every recession since 1976, each time giving us about 1 to 2 years heads up. Right now, it's flashing a critical signal that you absolutely can't afford to ignore. But what does this mean for you? By the end of this video, not only will you understand how to read this powerful signal like a pro, but also gain actionable tips to protect your investment and navigate through the next recession with confidence. So, if you ever felt uncertain about the future, stick around till the end. This video is for you. Before we dive into how this recession signal works, it's crucial to first understand what Treasuries are all about, as they are the building blocks of the entire signal. You've probably heard the term Treasuries thrown around in financial news, but what exactly are they? When the US government needs money, they don't go to the bank, they come to you, the public, and offer you 3 types of Treasuries: bills, notes, and bonds. Treasury bills or T-bills are the short-term options, maturing in less than a year, kind of like a quick loan to the government that pays you back a little extra when it matures. Treasury notes or T-notes are the middle ground, maturing in 2 to 10 years and paying you fixed interest, also known as coupons, twice a year. And lastly, Treasury bonds or T-bonds are long-term investments that matures in 10 to 30 years, also paying you fixed coupons twice a year. But why would anyone stash their money in Treasuries for 10, 20 or even 30 years? Simply put, the longer the bond, the better the yields. Why? Because longer-term bonds are subjected to greater uncertainty, such as potential changes in interest rates or economic conditions. Hence, to make these long-term loans attractive, the government offers higher yields to compensate for those extra risks. Plus, Treasuries are considered risk-free investments since they are backed by the full faith and credit of the US government, making them a stable choice for investors. Calculating the yield of a bond is also pretty straightforward. Just take the coupon payment and divide it by the bond's price. For instance, if a 10-year Treasury bond's price is $1,000 and pays $40 in interest annually, the yield will be 4%. However, yields can fluctuate based on the bond's market price. Since the coupons are fixed, if the bond price drops, the yield rises. And if the bond price goes up, the yield falls. So, how does knowing all this helps with predicting a recession? As mentioned earlier, longer duration equals more yield. But here's where things get crazy. During uncertain economic times like now, the yield curve can flip and slope downwards. What? Before you start freaking out, smash that subscribe button. I promise to uncover all the mysteries and keep you in the loop. Plus, subscribing is a great way to support the channel and make sure you never miss out on any of our latest and greatest content. So, back to this inverted yield curve. It's totally normal to be scratching your head right now. I mean, why is it inverted, and who would lock their money in a long-term bond for a lower yield than a shorter-term bond? It sounds foolish, right? Why not put your cash in a short-term bond and earn those higher yields? And that's a great point. The yield curve inverts due to a phenomenon known as flight to quality. During uncertain economic times, investors seek safety and flock to secure investments like long-term Treasury bonds. This spike in demand drives up prices. And since yield is calculated as coupon divided by price, and coupon payments are fixed, as bond prices rise, yield starts to drop, forming this inverted yield curve. Investors also don't mind accepting these lower yields because, by locking in a longer-term Treasury bond at today's rates, they protect themselves against future potential drops in short-term rates. In essence, they prioritize security and stability over higher short-term returns. Now that we've got a solid grasp on the yield curve, we are all set to predict a recession. The graph we see at the start of this video is known as the 10-2 Treasury spread, which is derived by simply taking the yield of the 10-year Treasury and subtract the yield of the 2-year Treasury. When the 2-year yield exceeds the 10-year yield, the spread turns negative, as marked in red on the graph, indicating an inverted yield curve. Conversely, when the 10-year yield is higher, the spread is positive, as shown in green, indicating a normal yield curve. What's really interesting is that whenever this spread flips from positive to negative, a recession follows shortly after. This powerful signal reveals how changes in investors' feeling and economic outlook can forecast a downturn well before it even happens. And guess what? With the way things are looking right now, we could be having a recession as soon as 2025. But here's the catch. While this graph is an excellent tool for spotting warning signs, using it as the backbone of your entire investment strategy would be a
Wait for it. Here it comes. Almost there!
mistake.
Huh?
First, let's clear up a common misconception. A bear market is defined as a prolonged period where stock prices fall by 20% or more from recent highs. It's not the same as a recession. Bear markets are driven by declining investors' confidence and can happen regardless of broader economic situations. Now, let's take a look at this market index chart to illustrate the point. The red bars represent bear markets, while the yellow bars represent recessions. As you can see, while the bear market and recession often occur together, they don't always arrive on the same schedule. A bear market can occur before a recession, during one, after one, or even in the absence of a recession. In some cases, it might not even materialize at all. The point is, markets are unpredictable, and trying to time them based on recession fears can lead to missed opportunities and costly mistakes. In fact, market downturns are often followed by strong rebounds, especially when government steps in with stimulus measures aimed at boosting economy growth. I know, 2024 seems like the perfect setup for an impending recession, but let's be honest, doesn't it feel like that every other year? This isn't the first time you heard recession fears making headlines. Times are always uncertain and there's always reasons for investors to be cautious. But while recessions are real and can be incredibly challenging, panicking isn't the solution. I can sense your frustration building, especially since I haven't laid out a clear action plan yet. So here's some actionable tips to help you weather whatever storms lies ahead. Firstly, know your risk tolerance. Everyone's got a different freak-out threshold when it comes to money. Some of us are cool as a cucumber in a market meltdown, while others panic at the slightest dip. The real question asks, how much market volatility can you handle before you start losing sleep? Should you even be invested? And if so, how much? As a rule of thumb, the younger you are, with strong savings, a high income, and solid job security, the more risk you can afford to take. Secondly, consider the degree of diversification in your portfolio. Are you the type that put all your eggs in one basket? Or do you spread your investments across various asset classes? Ideally, avoid the single basket approach. If a bear market hits and your investments are concentrated, you could face significant losses. Diversification helps manage risk because not every sector or stocks react the same way to an economic downturn. For instance, companies in healthcare, consumer staples, and utilities often fare better during recession than technology or growth stocks. Why? Because people will still need those essentials even when the economy takes a hit. Lastly, embrace market volatility as your opportunity. Sure, seeing your investments in the red can be stressful, but remember, the economy will bounce back eventually. The trick is to focus on high quality companies with solid fundamentals. These are the ones that can weather any financial storms and emerge stronger. You can either use strategies like buy the dip, picking up bargains when prices fall, or use dollar cost averaging, steadily investing a set amount over time to take advantage of the market fluctuations. Either way, you are setting yourself up for success when the market recovers. Want to dive deeper into these two strategies and see which one might be best for you? Check out the video link in the description below. Spoiler, it's not what you think. But hey, if you've been sticking to a disciplined investing strategy of your own, you're probably in good shape and not much changes are needed. Recessions are just temporary bumps and the market tends to recover and do well over the long term. Just remember to understand your risk tolerance, diversify your portfolio, and seize opportunities during market downturns. If you found this video helpful, drop a comment below with your thoughts or any questions you have. Don't forget to smash the like button and subscribe for more insightful content. Thanks for watching and see you in the next video.